Hello everyone. In today's video, we'll learn about one of the most important concepts in accounting, the difference between a journal and a ledger. Both are key parts of the accounting process, but they serve different purposes. Let's understand how they are connected and what makes each one unique. Meaning and purpose. Journal is the book of original entry where all transactions are first recorded. Ledger is the book of final entry where transactions are classified and summarized. The purpose of a journal is to record all transactions in chronological order. The purpose of a ledger is to group transactions under respective heads of accounts. Stage, nature and recording basis. The journal is the first stage in accounting. The ledger is the second stage in accounting. The journal is a primary book of accounts. The ledger is a secondary book of accounts. In a journal, transactions are recorded date-wise as they occur. In a ledger, transactions are recorded account-wise. Contents, process and arrangement, debit and credit columns. Each journal entry includes date, particulars, ledger folio, debit and credit amounts. Each ledger account contains debit and credit sides for that account only. The process of recording transactions in a journal is called journalizing. The process of transferring entries to the ledger is called posting. In a journal, entries are arranged chronologically. In a ledger, entries are arranged systematically according to account names. In a journal, both debit and credit are in one entry, while in a ledger they are on separate sides. Format, narration and usefulness. In a journal, both debits and credits are recorded in the same entry. In a ledger, debits and credits are recorded on separate sides of each account. The journal follows a journal format with narration for each entry. The ledger follows a T-shaped account format. Each transaction in a journal has a narration explaining it. Narration is not used in ledger accounts. The journal helps in analyzing transaction details. The ledger helps in knowing the balance of each account. Balancing, data transfer and record type. No balancing is done in a journal. Each account in the ledger is balanced periodically. Data is transferred from journal to ledger. Data is transferred from ledger to trial balance. The journal is a day-to-day record of transactions. The ledger is a summary record of all accounts. Preparation of financial statements, example and dependency, prepared by. We cannot generally prepare any financial statements directly from the journal. We can prepare financial statements directly from the ledger, but not so easily for larger businesses. The example for purchase of goods worth 5,000 rupees is recorded as a journal entry as purchases account debit to cash account, whereas in ledger, purchases account and cash account will be affected. The ledger depends on the journal for its information. The journal does not depend on the ledger. Journals are prepared by junior accountants, whereas ledgers are maintained by senior accountants. Objective, revenue and closing. The objective of a journal is to record each transaction completely for the first time. The objective of a ledger is to know the position of each account and prepare the trial balance. Journals cannot provide information about the total revenue earned during a period of time. The ledger shows total revenue during a period of time by summarizing all revenue-related transactions. Journals cannot help in finding the closing balance of an asset at the end of an accounting period. The ledger shows the closing balance of an asset because it summarizes all transactions affecting that asset during the accounting period. In short, the journal records transactions first, and the ledger summarizes them. Both are essential for keeping accurate financial records. Thanks for watching. Follow for more accounting videos.
Thank you.